Okay, hi guys. Today I'm going to be talking about taxes and education and just seeing how your taxes um can help pay for your education. Oh my gosh. Okay. So first, just like a little overview of what I'm going to be talking about. So first we have FAFSA, then it's going to be part-time earning and tax-free investments, and then education credits and tax benefits. So firstly, FAFSA. So what is FAFSA? FAFSA is this federal application for student aid, and it's need-based. So if your family doesn't make enough for you to realistically spend thousands of dollars a year on college, then the aid that you would get would be more. And this can qualify you for grants and scholarships or loans like student loans. And this paves the way for merit scholarships since colleges can't see colleges can't give you merit scholarships, which are scholarships based on how well you do in school until you've filled out the FAFSA. And most people are eligible for some financial aid. However, for a lot of people, because I'll go into this later, because it's calculated based on how much their parents make, not how much their parents are willing to put towards their college, this money doesn't help a lot. And this opens October 1st. So, in order to calculate how much money FAFSA gives you, you have the student aid index. And this is calculated using your family assets and income and household size. So, if your parents own like a house or two houses, and there's like five people in your family, and this goes from negative 1,500 to 999,999. And the lower your SAI is, the higher amount of need is demonstrated. So the more financial aid you are going to get. Then we have family income on FAFSA. And parental income actually has the biggest impact, um, but it isn't the entire thing. 50% of student income counts towards SAI. However, there is a limit or there is like a minimum that you would have to make to like qualify for 50% of your income to count. So if you made less than that, it wouldn't count. And your parents' assets also count for 5.6%. Retirement accounts and cash value life insurance accounts, however, do not count. And for the student income, that counts towards the SAI only the income above 11,130 counts. So here's like a chart on that. Your parents would they would count 22 to 47% of the income above the protected amount and plus the assets up to 5.64% of non-retirement accounts. And then for students, this is 50% of all income above 11,130 and 20% of all of the assets in like your savings account. So then now we're going to see how smart planning can actually help you increase aid. So for parents, different FAFSA weighting. Parents, if they put stuff into savings, if they had $10,000 in savings and invested, that would lose them $564, which is 5.64%. However, because for students, the same amount of money in the same type of account, if it was in the student's name, it would lose them 20% or $2,000. Next, we have income timing. So FAFSA uses tax information from 2 years prior. So if you're filing your FAFSA in 2025, like a lot of seniors are, you would pull out your tax information from 2023. So if you're expecting a bonus, you would strategically time it for a year in advance to avoid potential FAFSA SAI increasing, which will lower your financial aid. Then we have low student income. Students who make above $11,130 will have to they'll have to like count 50% of that towards the FAFSA. However, if you were to work less than that, you would just plan to work fewer hours to limit the amount of money that you're making so that you don't end up going over the threshold. You could also put start like putting your money into a Roth IRA if you did make that, since those contributions don't count as FAFSA assets, and that would put you under. And then for your shelter assets, just contributing, like I said, to your cash, like retirement plans and cash value life insurance, because those plans do not count. And this like lowers the taxable income and FAFSA assets. And also keeping college savings accounts in parent-owned plans and not in the students' names because, again, the parents are going to have less of a percentage taken away than the students. Now we'll move into part-time earning and tax-free investment. So there are two paths to investment. First is a cash value insurance, and next is a Roth IRA. So what is a Roth IRA? A Roth IRA is a retirement account that you can put money in and let it grow. It's tax efficient for the future since you don't pay taxes on that earnings. So any student with a W-2 or a 1099, as I think Cassie mentioned, which is just like your employer tax forms, whether or not you pay taxes by yourself or your employer pays them for you. And you can contribute up to $7,000, but it just depends. Like if you make under 120,000, you get the full 7,000. If you make 150, you get partial contribution based on a special formula by the IRS. And then over 165,000, you are not eligible for a direct contribution because there is a limit. So now for the benefits. So these growths and withdrawals are tax-free. So the amount of money that you put in and like how, depending on how long you leave it for, how much money that has grown in that account, that will not be taxed. And these contributions can be withdrawn without penalty. So if this retirement account were to be um, taken out when you turn like 65, like I'll mention later in the life insurance account, there will be no penalty. There is no um, deduction for taking it out early. And additionally, this is not counted in the FAFSA because, well, this is just not counted in the FAFSA. And then some drawbacks for this. It's a low limit. $7,000 is not that much money, especially if you do make a lot, like since the maximum is for the full 7,000 is 120,000. And the earnings, not the contributions, can be taxed and penalized if withdrawn before a certain date. So you can take out the money that you put in, but you can't take out the money that's grown. Next, we have cash value insurance. And some pros of this are a tax-free investment, just like the Roth IRA. However, this is more flexible than the IRA from the Roth IRA, and there is no income limit. So it doesn't matter if you're making $100,000 a year or 3 million. There's no limit on how much you can put in, and there's no limit on if you can put money in. And then there's a wide contribution range, and oops, sorry. And you can use this money before you turn 59 and a half, which I'm pretty sure you can't do with a Roth IRA. And then the cons of this is it's a very long-term investment because you typically won't see this money until you're old. And because it's life insurance, you do have to be healthy to qualify, just because they don't want you buying it and then dying, um, because of a sickness. So, but either way, both are great vehicles to save taxes in the long run. So now we're going to move into tax credits and education benefits. So first, there are two main ones under this category. There's the opportunity tax credit, which I'll talk about first. And this is just a federal tax credit designed to help students pay for college. And you must be an undergrad, so you have to be in your first 4 years of college. And the max you can get is $2,500. And this amount is refundable up to $1,000 or 40%. And in this graph, it's just showing you get 100% of the first $2,000 of qualified expenses, 25% of the expenses in the excess of 25,000, and the maximum that you can get is 2,500. Next, we have our lifetime learning credits. And this is not limited to the first 4 years. So it doesn't matter if you're like 40 and you're taking college classes, or if this is just your first year. It doesn't matter if you're an undergrad or a graduate student. And you claim the first 20% of the first $10,000. So that would be $22,000. And it is non-refundable. So you can't get like money back that you've spent, as seen in like the graph. Let's see. And this is just talking about when you can claim these. So because these two are very similar, you're basically getting qualified education expenses paid for during the tax year. And you can claim the American Opportunity Tax Credit if you haven't claimed it for over 4 years. And if you're a single person making under 80,000 or married and making over 160,000, you can qualify. Um, yes. And then for the lifetime learning credit, this is claimable anytime a student, again, is in school and meets the requirements. So you can claim it for any number of years. However, you can't claim the American Opportunity Tax Credit and the Lifetime Learning Credit in the same year for the same student. However, if a parent had like two siblings going in college in the same fiscal year, you would be able to claim the American Opportunity Tax Credit for one kid and the Lifetime Learning Credit for another. And that's all I have.